Okay, so what we're going to be doing today is fielding questions from you guys about the financial literacy information. If you guys have any questions about the website that you went through, hopefully you started on that. It's due Friday. It's kind of a lot of work, so make sure you get started on that immediately if you haven't done so. But there's a lot of content in there about loans and credit cards and identity theft and so forth. So I'm gonna talk to you about insurance. Ms. J is going to talk to you about debit and credit cards and loans. Before we get into that, does anybody have any questions about any of the material that they need answered? No? Okay. All right. So what I'm going to do is I'm going to put a whiteboard up here and talk to you guys about insurance. Okay. Now, insurance, I've heard students say it's a ripoff. I've heard students say in the past it's necessary. It depends on the type of insurance, I think, but basically insurance is you're put into a pool, okay? And you are all in this pool. And it's supposed to minimize a financial risk. So everybody that's in this insurance pool pays money into it, okay? Money comes out of the pool when somebody in the pool needs it. So it might be, an accident, or they might need, medical coverage. Okay, something like that. So let's talk about car insurance, because I think that's the easiest one for you guys to understand. Ohio law says you have to have car insurance. Okay, so in this project that you do next week, where you're making a family budget, you have to have car insurance because you're going to have a car. Okay, now, the way car insurance works is like all other insurance, okay? You are in with a bunch of similarly situated people, and everybody pays their premiums, okay? And that's what goes into the pool. And then when somebody needs the money, for instance, in car insurance, you have a car accident, okay? If that car accident is your fault, you could very easily rack up a bill of, between your car and somebody else's car, $20,000. Well, rather than having to drain your savings account, if you're lucky enough to have $20,000 in a savings account, what you do is, as long as you've paid your premiums, out of this pool comes your $20,000 minus your deductible. Okay, and your deductible is the amount that you have to pay. Sometimes it's $250, sometimes it's $500, sometimes it's $1,000 for car insurance. Okay, so let's say it's $1,000 your deductible. They'll give you, not you, but they'll pay the people that repair the cars a total of $19,000. Okay, now depending on your situation, that determines what pool you're in. For instance, car insurance, you guys, they separate the ladies from the guys, okay? Because the guys are worse drivers statistically than ladies, okay? So there's somebody that works at the insurance company, they're an actuary, and they determine the risk of somebody, okay? So since teenage boys have more accidents than teenage girls, they put all teenage boys into this insurance pool, and their insurance is a little higher. Me, as a middle-aged man, statistically, I'm a safer driver than teens, okay, especially teen guys. So I'm in a different pool. My rates are lower than yours, okay? So it puts people statistically that are in the same kind of statistical category together, and that helps determine how much their rates are, okay? So if you're a female teenage driver, you're in a different pool. Your rates are still kind of high compared to mine as a middle-aged guy, but your rates are still lower than a teenage guy because you get into less accidents. So teenage boys are the worst drivers statistically, so they're going to have the highest rates. As you get older, especially when you turn 25, or you get married, your rates go down, because statistically, once you reach 25, the actuaries have figured this out. You have a less of a chance of getting into an accident that's your fault. When you get married and you have children, people tend to drive better and more carefully when they're married and they have children. Okay. So when I turned 25, about 2.5 weeks later, I got married. So my rates were like cut in half. It was a big raise for Mr. Ficker at that point on his car insurance. So my rates got lowered. Okay. Any questions about that? It's basically how insurance works. Okay. Now, what other kind of insurance can you get? You can get life insurance. You can get medical. And you can get property, we'll call it homeowners insurance. Okay. When you do this project, you are required to have car insurance and homeowners insurance, because that's what the law says. If you're a homeowner, you have to have insurance in case something goes wrong with your house. You know, your roof is ripped off by a windstorm or something like that. Again, you pay your deductible. That repair is probably going to be $15,000. Rather than having to pay $15,000, you pay your deductible and the insurance pool covers the rest. Okay. Medical insurance. So we did home. Medical insurance is exactly that. And in the project, we're going to assume you have medical insurance through your employer, because that's how most people get their medical insurance. But basically, you're in a pool of workers that you work with. So Mr. Barkalow and I are in the same medical insurance pool with all the rest of the Northwest Local School District employees. Now, the thing about insurance is, I'll use Mr. Barkalow as an example. He's a young guy. He's in great shape. He makes good decisions. But what if I, as a middle-aged guy, my doctor says, "Hey, you're getting a little heavy. Your diet's bad. You're in line for a heart attack," and I have a heart attack, and so does a whole bunch of other people, and we rack up medical bills of $1 million. Okay, Mr. Barkalow's rates, even though he's a healthy individual, are going to go up because the people in the pool have used the insurance more than they expected, so they got to make up for that. So they raise everybody's rates. So connecting that to car insurance, you can be a great driver. You can get, in no accidents. But if you're in an insurance pool with a bunch of other teen guy drivers that get into a bunch of accidents, your rates are going to go up. That doesn't seem fair. Okay. However, look at it this way. If you were to get in an accident, they're there to cover you as well. So again, you're minimizing the financial risk here. The other type is life insurance. We're going to make that optional because in life insurance is optional for the project. Life insurance, it really shouldn't be called life insurance. I would call it death insurance because I have a life insurance policy. I think it's about $200,000. I don't get to see any of that. I pay a monthly premium and I don't get to see that. If I were to die, statistically, I'm probably going to die before my wife. I hate to talk about things like this, and before my children. So if I pass away, they get that $200,000 divided up evenly between them. Okay. And most people have at least enough life insurance to cover their funeral and their burial costs. And, perhaps, something that's going to help their spouse pay off the bills. So, but I'll leave that optional for you if you want to get life insurance in this project. And one other thing about life insurance, your homeowner's insurance is based on the value of your home, how big your home is, how old it is, what's the market value. Medical, it's just how much you use. Life insurance, when you fill out a life insurance form, the first question they ask you is, are you a smoker? Do you smoke cigarettes? Anybody know, and you can shout it out, anybody know why? That's the first question they ask you. Nobody knows that one? If you're a smoker, what happens to your life expectancy? It goes down. So they automatically, immediately separate smokers put smokers in a different pool than non-smokers. I'm a non-smoker, so my rates are going to be a little lower than theirs because non-smokers tend to live longer than smokers. Okay. All right. Any questions about insurance? No? Okay. All right, Ms. J, I'm going to turn it over to you. I am going to make you the host.
Okay.
Okay. First of all, I'm allowing you to record. I think I'm doing this correctly. And now you are the host.
Now I can share. Okay. So I'm going to be talking with you all about credit cards and loans. So these are going to be things that are going to be really important to your project, including the information that you turn in this Friday, and then when you do your personal finance project. But honestly, credit cards and loans are probably going to be things that you are starting to look at and use right now in your life as well. So starting off some vocabulary that you're going to just hear throughout this, interest rates. And so with credit cards and loans, either a loan company or the bank is lending you money, but they're not just going to lend you money for free. So there's what's called the interest rate. And so that is the percentage of money that you have to pay back to the either bank or company for allowing them to lend you the money. So if somebody lends you $100 and then they have a 5% interest rate on it, you have to give them back the $100 once you make enough money to pay it back. But then you're also going to have to give them $5 just for lending you the money. And so when you're applying for things like credit cards and loans, it's going to have what is called the APR, and that's the annual percentage rate. So that just means how much interest you're going to pay each year for these people to lend you that money. And then lastly, the other thing that plays into getting credit cards and loans is your credit score. And so this is a number between 300 and 850. And it shows lenders, so those banks and those lending companies, how dependable you are. So the higher your number, that means great. When you lend this person their money, they are going to pay you back for sure. So your interest rates will be lower because the company is going to trust that they get their money back, and they also may lend you a little bit more money. So the better your credit score, the easier it's going to be for you to open up credit cards and get loans. But that means you have to continue to still pay them back on time with the correct amount of money so your credit score stays good. So starting off with the easier of the ways to get money lent to you, there's debit and credit cards. And so debit cards, there's no money lending involved. Instead, a debit card is, your card, but it is tied directly to your checking account. So for instance, I got my first debit card when I was 15 because that's when I got my first job. So it was the first time I had a bank account with money going into it. But my debit card is tied directly to my checking account. So I couldn't spend money I didn't have. When I swiped my debit card, the money immediately came out of my bank account. It took it away. And this is what you use when you have a PIN, which is your personal identification number. Typically, it's 4 numbers that you just type in at the checkout. And it's a way to make sure you are never spending more money than you have. All it is a way to connect your debit card to your bank account and spend the money that you have. A credit card is a little bit different. A credit card is the type of card that you can use where the bank gives you what is called a line of credit. So basically, they say each month we will lend you this much money. And you can spend that. It just means at the end of the month, you have to pay us money back. So you can swipe your card. Money is not going to come directly out of your bank account. Instead, at the end of the month, you have to use your checking account to pay off the money that you spent on your credit card. And you can only spend, though, the amount that the bank lends you. So if your line of credit is $1,000, you can only put $1,000 worth of purchases on your credit card. And then at the end of the month, you have to pay that balance back. Credit cards are a good way to build credit. So if every month you put expenses on it and then you pay it back. It's going to show that you are a dependable spender and a dependable lender. So that's a good way to build credit. That's why I opened up my first credit card. But I did something very important with my first credit card, and it may be something for you guys to think about when you're opening your first credit card. The bank is not just going to lend you money and then not let you pay it back. So if you hit the end of the month and you don't have enough money in your checking account to pay off your credit card, they're going to tack interest onto it. And credit cards have typically pretty high interest. So my credit card is around 14 or 15%. So let's say the bank gives me $1,000. I'm not saying I have $1,000, but let's say they say I can spend $1,000. And I get to the end of the month and I'm like, shoot, I don't have $1,000 to pay back. They're going to charge me $140 additional just that month because I couldn't pay them their money back. And so that is pretty easy to collect credit card debt. And so since I'm pretty young, the first credit card I opened, I did what is called a secure credit card. And the bank was like, you don't have credit because I'm young, I haven't had the opportunity to build it up yet. We're going to place money on hold in your account that is the same amount as your line of credit. So if they gave me $100 on my credit card, they're going to place like $100 hold on my bank. So I can't spend that $100. So that way at the end of the month, even if I spent all my other money, that $100 of mine that they placed on hold can be used to pay off my credit card. And it's to ensure that I do not get any type of credit card debt. And like I said, I'm pretty smart with my money, but I still got my first credit card and I was like, it feels like free money. It's not free money. You have to pay it back 30 days later. So that's really important to remember, which is why the secure credit card would be a smart option if you're looking into getting one at a young age for your first card. Okay. And so then let's say you still need to make some big purchases, but you don't have enough money in your bank account to do it. Obviously, most people don't just have $100,000 sitting in their bank account to go purchase a house, or even things like a fridge or a washing machine. Some of those big purchases might be something where you have to take out a loan and pay back slowly over time. And you're thinking, there's multiple different types of loans, but the four that I wanted to focus on were personal, auto, student, and mortgage, because they're going to be big ones that you have for your project, but also ones that you're probably going to be encountering coming up pretty soon in your lives. So your first one being personal loans. And so this is typically low interest loans that you can use for big purchases. This is going to be like your washing machine or your, fridge, things like that, where they're expensive, but it's not like a house or a car. And you're thinking, why don't you just put it on your credit card? Well, maybe your credit line isn't enough. If your credit line's only $1,000, but you want to get a $2,000 fridge, it's not going to cover the cost of it. Second, personal loans typically have a lower interest rate. So if you put, your fridge on your credit card and you can't pay it off at the end of the month, but you have a 15% interest rate, that's a lot of money. So personal loans typically have a smaller interest rate, like 4 or 5% that you pay back. So it's an easier way and a better way for you to be able to pay off some of those big purchases. And the personal loans can be used towards anything in your life that you need it, just as long as you get it approved. The second one is auto loans. And so these are used to purchase your cars. The average auto loan lasts about 6 years. So it usually takes you around 6 years to pay off your car and give the bank back the money that they lent you. The average percentage rate, the average APR, is around 3 to 4%. So you're going to be paying back 3 to 4% of the money that they loaned you each year. Your mortgage, this is the type of loan that you use to purchase your home. Mortgage loans are usually done in 10-year increments, 15-year increments, 20 or 30 years. And the average APR is around 3%. So you're thinking, wow, 3%, like that's a super small number. That's super great. But if you purchase a $100,000 home, every year you're going to be paying back $3,000 just for them lending you that money. That's what 3% is. And so some of those bigger loans have smaller APRs. So you're thinking that's great. But 3% of a big purchase is still a lot of money. So that's an important thing to pay attention to when you're getting those loans, and making sure not only do you have enough money to pay back the loan, but enough money to pay back interest. And then lastly, student loans. So this is going to be something that a lot of people have to use within the next coming year as juniors in high school. So these are the loans that you use to attend higher education. And I just wanted to tell you about the two different types of student loans you can get. So when you fill out what's called the FAFSA next year, it's one of those really long, boring forms that you have to fill out with your parents to get approved for loans, that you know the two types of loans that they offer to you. So the two types of student loans that you can get, the first one is called an unsubsidized loan. So this works just like all the other loans that I just talked about. You have to pay back interest on it every year. And so each year that you have this loan, it is collecting interest on it. So the longer it takes you to pay back, the more money you're going to pay. And unsubsidized loans are not based on need. So as long as you have a good enough credit score to get a loan, pretty much anybody can get one of these unsubsidized loans. The next type of student loan you can get is called a subsidized student loan. And so this one is based on need. So if you kind of need more financial help paying for school, you're going to get offered these subsidized loans. And that's because you do not pay interest on subsidized loans while you are a student in college, and then after college for the first 6 months out of college. And so what that means is the 4 years, if you're in college for 4 years, your loans don't collect interest. And then after you leave college for 6 months, they don't collect interest. So you have that time to pay back the student loans without any sort of that additional fee. They do this because it's hard for college students to be able to pay back student loans sometimes. I'm in college full time, so I don't get to work as much as I would be able to if I wasn't in school. So they take that into consideration. They don't start collecting interest until you get out of school. And this is what's called one of those federal student loans. That's what you hear about when people talk about the federal student loans. That's those subsidized loans. The federal government is helping you out and making sure that you don't collect interest on your loans. Does anyone have any questions about those either loans or getting credit cards or borrowing money of any type? Okay, great. The last thing I wanted to leave you all with was thanking you all for a great year. This is my last Wednesday with you all. I'm graduating college next week. So I will still be around, but I will not be in any more of the Wednesday Zoom meetings. And it was just really great working with you all. I liked seeing you on Zoom. The couple of you that I got to see in person, it's been great. And then just, working with your assignments. Thank you all for completing all of them and putting in such a hard work and a great effort. It made my year really enjoyable with you all for student teaching. And so I just really appreciate being with you all.